Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome. So, if you're a business owner in Canada, selling your company is probably the biggest financial moment of your life. And a huge part of maximizing what you walk away with is something called the Lifetime Capital Gains Exemption. It's a really powerful tax break. But here's the catch. To get it, your company has to pass a critical test. That's where a process called corporate purification comes in. And today, we are going to demystify exactly what that is. So, here's how we're going to tackle this. First, we'll start with the most important rule you need to know, the 90-10 asset test. Then we're going to get really practical and look at how you actually classify your company's assets. From there, we'll dive into the actual strategies for purification, and we'll wrap up with what is, by far, the best approach to make sure you're always ready.
Okay, let's get right into the thick of it. Before we can even talk about purifying a company, we have to understand the specific hurdle we're trying to clear. The thing is, at the very moment you sell your company, it has to pass this one very specific test. The rule comes from a key phrase in Canada's Income Tax Act, all or substantially all. What it's saying is that at the time of the sale, all or substantially all of your company's assets, when measured by their fair market value, have to be used in an active business. Now, all or substantially all might sound a little fuzzy, right? A bit vague, but in the tax world, it's not. The Canada Revenue Agency and the courts have landed on a very clear, hard number for it, 90%. That's the threshold. No wiggle room. So you have to wonder, why? Why does the government have such a stringent test in place? What's the thinking behind this 90% rule? Well, the logic is actually pretty straightforward. The government wants to reward active operating businesses, not what are essentially personal investment portfolios disguised as a company. The whole point is to stop people from building up a company full of passive investments like stocks or real estate and then selling the company to cash out that value at a lower tax rate. The 90% test is there to make sure the tax break goes to genuine entrepreneurs. So if 90% of your assets have to be used in the business, how on earth do you figure that out? It really comes down to a very practical exercise, sorting every single asset your company owns into one of two simple categories. Here's how it works. First, you value everything at its current fair market value. Then, you put each asset into one of two buckets. We call them good assets and bad assets. A good asset is something that's used principally, and that's a key word, meaning more than 50% of the time, in your active business. Think your delivery van or your office furniture. A bad asset is simply everything else. The goal is simple. The total value of your good assets has to be at least 90% of the grand total. Okay, but this is where it gets really interesting. The theory is one thing, but how does this all play out with assets that aren't so black and white? This is where the real analysis begins. Now, the CRA doesn't hand you a nice, neat checklist of what's bad. But from experience, you see the same culprits pop up again and again. The most common bad assets are things not directly tied to your day-to-day operations. Excess cash just sitting there, investments like stocks and bonds, or even loans you've made to employees. And another really tricky one is an asset you've bought for a future project but aren't actually using yet. Cash is a huge issue, especially for successful companies that are making good money. The line the tax courts have drawn really comes down to one word: stability. If taking that cash out of the business would destabilize your operations, you couldn't pay payroll, you couldn't pay suppliers, then it's likely good working capital. But if you can pull it out and the business just keeps humming along, well, that's a bad surplus. And this brings us to one of the biggest and most common mistakes I see business owners make. They think, hey, I'm saving up all this cash for a good reason. I need to buy a new machine in 2 years. It makes perfect business sense, right? But from a tax perspective, that's just not true. The test isn't about future intended use, it's strictly about current use. If that cash isn't being used in the business today, it's a bad asset, period. Let's make this really concrete with an example. Imagine a company owns its own $4 million building. They use half of it for their own operations, and to bring in a little extra cash, they rent out the other half to a tenant. So the question is that entire $4 million building a good asset or a bad one? Well, to figure it out, we have to find its principal use. What is it doing more than 50% of the time? If you just measure by square footage, a 50-50 split actually fails the test. It's not used more than 50% for the business, so it would likely be a bad asset. What if we measure by economic value?
If the tenant is paying 60% of the total market rent, then its main purpose is generating rent. Again, it's a bad asset. But if the company's own operations account for the majority of the value, let's say 60%, then it passes the test. It becomes a good asset. And this shows you just how crucial this is. The 90-10 test is all or nothing for each asset. If that building is deemed a good asset because it passed the 50% test, you don't just get to count the portion you use. No, the entire value, the full $4 million, gets dropped into the good asset column. It's a massive swing. So let's say a business owner does this whole analysis and discovers they have too many bad assets. Maybe they're sitting at 15% of the total value. What's the fix? Well, this is where the concept of purification finally comes in. Purification is really just what it sounds like. It's the process of cleaning your corporation's balance sheet. It means you're actively managing your assets to get rid of the bad ones, maybe by selling them, spending them, or turning them into good ones, all with the goal of getting over that 90% finish line before you sell. Okay, so how is this actually done? Let's look at the specific strategies, the actual game plan for purifying a company's assets. You've got a few common plays. If your problem is excess cash, a classic bad asset, you could use it to pay down debt. That just makes the bad asset disappear from the calculation. Or you could use that cash to buy a good asset, like new equipment that you can put to work immediately. For other bad assets, like a piece of vacant land, the most direct approach is pretty simple: sell it. But, and this is a really big but, these strategies come with a major catch. If you sell a bad asset that's gone up in value, like that piece of land, you might solve your 90-90 problem, but you've just triggered an immediate capital gain inside the company. You've created a new immediate tax bill. You're basically trading one problem for another. And that really gets to the core of the issue. Trying to do this purification dance in the last few weeks or months before a sale is incredibly difficult. Your options are limited, and trying to manage it all in a tax-smart way while a deal is on the table, that is a high-pressure, high-risk situation. This whole difficult situation leads us to the most important takeaway from our entire discussion today. It requires a shift in mindset, from being reactive to being proactive. So instead of that last-minute scramble, the absolute best approach is to make purification an ongoing part of your financial discipline. If you're regularly monitoring your asset mix, you can make small strategic moves over time. This lets you plan everything in a tax-effective way, and, most importantly, it ensures that no matter when a great offer to sell your business comes along, you are ready and compliant. You avoid the crisis. So I will leave you with this question to think about. Is your business truly prepared for a sale at any given moment? Because thinking about purification isn't just a pre-sale tactic. It is a fundamental part of sound, long-term financial management that can save you a fortune in taxes. Thank you for your time.